Hi there, it's Natasha here, and my job is to help as many people as I can to negotiate the right divorce settlement. I've put together a series of case study style videos covering a variety of topics to help give you a better understanding and some clarity around different areas of divorce. Whether you're a legal advisor or you're going through a divorce yourself, hopefully you'll find the information I'm about to share with you helpful. And today I'm going to go through a case study to help highlight how varying amounts of maintenance income can affect an individual's capacity to mortgage. I've based this case study on a single person, age 40, with a 10% deposit available towards the purchase of a new property. I've also assumed they will have 2 financially dependent children and therefore will be in receipt of child benefit of £1,788 per annum, which is £149 a month. I'll also assume they're earning £30,000 per annum also. Now, based on these details, I will compare how maintenance income of £4,800 per annum, which equates to £400 per month, will affect capacity to mortgage in comparison to doubling the amount of maintenance, which is £9,600 per annum and £800 per month. Firstly, what is important to understand is how mortgage lenders will treat this particular income, because criteria can vary drastically. Now, if the maintenance income has been court ordered or has been arranged via the Child Maintenance Service, most mortgage lenders will use this income when calculating the amount they will lend. However, if this income has been arranged privately, some lenders do become more cautious and some will not consider this type of income without a formal arrangement in place. All lenders will of course require proof of this income being received, usually in the form of a copy court order or CMS letter. And for privately arranged maintenance, bank statements will be required, normally for a period of 3 or 6 months, although there are a few lenders who may ask for a 12-month history. Of course, there are always a couple of providers who simply will not use this income whatsoever. Furthermore, it's also important to note that certain lenders will only use a percentage of maintenance income when calculating borrowing, and this is usually between 50 and 65%. There are also providers who require the income to be payable for the entire term of the mortgage. So if we apply that to the case study detailed earlier, casting your mind back to the beginning of the video, I used an individual's age 40. So let's say the mortgage will run to their 65th birthday, or for 25 years. If we assume the youngest child is 8 years old and the maintenance income will stop when that child turns 18, then the income will fail to satisfy this criteria and therefore may not be used for mortgage lending purposes. So I'm sure, as you can see, lending criteria is extensive and advice should always be sought where this type of income is concerned. So, based on the criteria I have just discussed, the results of this type of assessment would be highly likely to vary drastically, particularly where large amounts of maintenance income are concerned. And maximum lending based on this case study could be as follows. For the lower amount of maintenance income, which was £400 per month or £4,800 per year, most lenders would use some or all of this income, and maximum borrowing would be around £160,000. For the higher amount of maintenance income, which doubled to £800 per month and £9,600 per year, the maximum borrowing would increase to around £180,000. As you can see, the extra maintenance would allow an individual in these circumstances to borrow approximately £20,000 more if the higher maintenance income was arranged. Now, this may be acceptable for some, however, others may have anticipated the increase in maintenance to be more impactful. Instead, perhaps this assessment could be used to highlight how much more effective and less costly it would be to allow the individual in these circumstances to receive an additional £20,000 from the marital pot, instead of receiving the higher amount of maintenance, which in the next 10 years would equate to £96,000. In any event, a mortgage capacity assessment will provide a realistic indication of how the divorce settlement can affect future mortgage borrowing before any financial decisions are made. If you would like to purchase a mortgage capacity assessment, please download the relevant pack from our website or call me on the number showing on screen. And that's all from me today. Thank you for listening. I'm Natasha, helping you negotiate the right divorce settlement.